Are the high interest rates causing you to sit on the sidelines and be in paralysis in this moment? Well, we're going to talk through the things you need to know before you decide to invest passively with a real estate group. Now is a critical moment in real estate investing where you need to take a deep dive inside of the group that you're looking to invest with and ask some critical questions about how they're putting deals together, how they're financing their deals, and what their strategy is given the high interest rate environment we're in today. We're no longer in a low interest rate environment, so whichever operator you guys are looking at investing with, you need to have a thorough understanding of how they're pivoting their strategy given the change in interest rates, because that could be the difference maker between you making money or you losing your entire investment. Before we jump into this, let's get some key terms out of the way so that once we get into the example, you'll have a thorough understanding of what it is that we're talking about. The first metric we're going to discuss is your IRR, which is a function of your cash flows from the moment you invest until the moment you get all your money back and exit the investment. So let's use an example of you investing $100,000 with an operator that has a multifamily development deal going on. You invest your $100,000 today. The next 2 years, you don't see any money coming out of it because they're building the project. By year 3, you get $5,000 back once revenues are starting to come in. Year 4, that jumps up to $10,000. And by year 5, you receive a lump sum payment of $200,000 once the property is sold. That would equate to an IRR of just under 17% on your investment. And so that's your aggregate annualized return for the duration of the investment that you made. Now let's jump into NOI, or net operating income. This is a term that's used primarily for real estate investments that is an indication of your income less your operating expenses, which give you your NOI. And the one expense, and this is a common mistake that a lot of people make, the one expense that's not included in your NOI is your debt service, meaning the payments you have to make on the loan that you take on the property. Interest rate on your loan. Now, many of you probably know this, but we'll touch on it regardless, just to bring everybody up to speed. That is the amount that the bank is charging a particular borrower in exchange for the money that they receive. Now, typically, the higher the interest rate on a loan, the lower the profitability of the project. The lower the interest rate on the loan, the higher the profitability on the project. Your DSCR, or your debt service coverage ratio, is the primary metric by which lenders are determining your ability to qualify for a loan. Now, the DSCR is a numeric value that represents the amount of money available to pay the debt that's in question. So a DSCR of 1 means that every single dollar you generate in revenue is offset by your loan payment, meaning every dollar that comes in is going straight to the loan. Now, the bank's benchmark is typically 1.25, which means you're generating 25% extra income above and beyond what the loan payment requirement is. Now, they want that 25% extra cushion to account for any deviations that may take place over the duration of the loan with respect to your income. So given that we're in a high interest rate environment now, let's briefly talk about what happens with respect to interest rates. When interest rates are low, the cost of capital for a borrower is low, meaning profitability go up. So an operator who's looking to do a development will basically look at this and say, if I can pay 3% to a bank for a loan or 10% to an investor, the cost of my loan is significantly less. I'm going to borrow as much as I can. Now, when rates go up, obviously profitability goes down. But the thing that we want to stress in this video is not necessarily the profitability issue per se. It's more about a development deal where a borrower borrows too much money, rates go up on them, and then the ability for them to refinance out of their construction loan and into their permanent loan gets called into question. And that's the example we want to jump into, because this is the part for you as a real estate investor that could potentially put all of your money at risk given the environment that we're in today. Now let's compare a deal in 2021 and how it was done then to how it would have to be done now in 2023 given the higher interest rate environment that we're in. In terms of deal metrics, we'll look at the exact same deal so that we have a full apples to apples comparison. Total project cost on the project will be $15 million, and we'll be bringing 15% equity into the deal and financing 85%. That would mean we would be bringing in $2.25 million of equity and borrowing $12.75 million from the bank. Our expected NOI at completion is the same for both 21 and 23, set at $975,000. Our DSCR and amortization in terms of the number of years that we're amortizing the loan for are the same in both scenarios, with DSCR being set to 1.25 and our amortization schedule set at 30 years. And the only metric that changes between the 2021 and the 2023 scenario is that interest rates, with 2021 being set at a 3% refi rate and 2023 being set at 275 basis points higher or 5.75%. Now, in coming up with the refinance amount, the calculation is a little bit cumbersome, but effectively what you would do is you would take your NOI and divide it by your expected interest rate times your DSCR, and then you would have to take your present value. In order to help you with this calculation, if it's something you're trying to do for yourself, we included a link at the description of this video so that you can enter in some of the deal points and it will do the calculations in a present value for you. So let's take a look at how it all plays out in 2021 with a 3% refi rate. We're expecting to get a loan amount of about $15.288 million. And as a reminder, we borrowed 12.75, which would give us a cash out refi of about 2.5 million bucks. Jump over to the 2023 scenario where the interest rate on the refi is 5.75. Our refinance amount would only allow us to get $11,030,000. Now, given the fact that our construction loan was $12.75 million, in order to refinance out of construction and into this loan, we would have to bring $1.7 million of additional cash into the deal in order to qualify for the loan. So this is the part that you have to be extremely mindful of as a passive investor. How are the groups that you're looking to invest with handling the management of debt given the high interest rate environment? The problem is a lot of them are just banking on the fact that interest rates will drop in the next 12 to 24 months when their construction projects come to a completion. That is not a risk that you should consider taking for yourself, because as you can see, what would end up happening is if rates don't go down, they're going to have to come up with more money. And if they're not able to come up with more money from other investors or by reaching back out to you for more money, they run the potential of losing the project altogether. Now, one of the things that we're doing in situations like this is we're actually bringing a lot more equity into the table at the beginning, demonstrating for our investors that by bringing in more cash to the deal, targeted returns may be lower than where they were a couple of years ago, but we're also removing the greatest risk that we believe to exist in this moment in time, which is the inability to refinance. By bringing the extra equity to the table, we're locking in long-term debt. So instead of having a loan that matures in 2 years when construction is done, our loans are maturing in 10 or up to, in some cases, 25 years. And that eliminates the need to refinance. So we no longer care, or we're not as concerned with what happens to the interest rates if they continue to stay high or even go up higher, because our debt is longer term in nature, and so the refi risk has been mitigated as a result of it. But for you as an investor, it's critically important. Don't just look at the return targets for these groups. If they're showing you return numbers that look the same as the jobs that they were doing back in 2020 or 2021, or even up to 2022 before we started seeing these interest rate hikes, you have got to go past the curtain and find out how is it that they're getting those numbers when cost of financing has gone up so significantly, because there's probably something there that you need to expose in order to determine whether or not that's a smart investment for you to make. We hope you found this information useful. Make sure to like, comment, and subscribe to our channel. It helps us out tremendously with the YouTube algorithm, and we'll make sure we'll see you on the next one.